Well, good afternoon, everyone. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. I want to welcome you to this week's Mortgage Minute. It's a beautiful, clear, sunshiny day here in the Coachella Valley. So I want to go ahead and get right into our program today. As you know, we always start off by giving you an update on interest rates in the bond market. And it's relatively good news, although at the same time, what I'm going to show you here in a minute is a good example of that quote that I've put on the bottom of our first slide in terms of interest rates updates about the financial markets and how they react with reptilian minds to stimuli. So we have a little bit of that going on this week, as I'll share with you here in just a minute. So first, let me go ahead and show you where are we at with rates. Rates are hanging in there okay. It's interesting. A little bit of an uptick from last week's program, but we're still, well into the sixes with just about every conforming loan program. We did give up a little bit on FHA VA. You may recall last week we were actually under six, like 5 7/8. We're back up over six just a little bit, but overall, still looking pretty good across all program types. It was interesting this morning when I was watching the financial news on CNBC. Very early in the morning, they post mortgage rates on their program daily, and they were indicating a 30-year fixed conforming loan was about 7.09. Well, not true. We can still get you a rate in the upper sixes, 6 7/8, 6 3/4, depending on the transaction. So, again, the media is a little bit on the high side as to where rates are at. When you look at the bond yield, the 10-year bond yield chart tells a pretty good story overall. If you look at this is for the last 5 days. Right now, the 10-year bond yield's about 4.48, which is actually a slight drop from where it opened this morning. We actually had an uptick this morning. It got as high as 4.50. And you can see if you go back to last Friday, we were down in the 4.35 range. What's good about this is we have a relatively stable period now for about 3 weeks where the 10-year bond yield has been kind of maintaining itself between about a 4.35 to 4.50 range. And I think that's, generally good news that we haven't had a wild uptick, getting up closer to 4.75, 4.80 or approaching 5%. This is, stability can be a good thing in the bond market and therefore the interest rate market. So I think overall, we should be thankful that we've stayed within our fairly narrow range, again, between about 4.35 and 4.50 on the 10-year bond yield. So in terms of what's been going on this week to get us to these numbers and this little bit of an uptick late this week, a few things. First of all, in terms of economic data, the calendar overall this week's pretty light. Very little first part of the week, Monday, Tuesday. I put on here Fed speak because on Monday and Tuesday were various Fed governors and so forth who were speaking at different engagements. And of course, we also had the release of the Federal Open Market Committee minutes. That's the Fed minutes after their last meeting. And those minutes did not really tell the markets anything that they already didn't know, which is the Fed is surprised that that inflation is remaining sticky and that we're not to their 2% target yet. And so while the Fed still says there should be some improvement or reduction in the Fed funds rate this year, they've backed off their earlier comments as to how many rate cuts and how deep. So again, the minutes really weren't a surprise. New home sales and existing home sales, those are interesting. Those were released this week. They didn't really move the market much. Both were forecast lower, and that proved to be true. Existing home sales for April were down about 1.9% nationally, about 4.14 million units. New home sales, though, surprisingly, which has been sort of the star in this difficult, challenging time in the last year or two, new home sales in April were down. They were down about 4.7% at an annual rate of about 634,000 units. Again, that didn't move the market much, but again, at least it underscored a relatively soft economy from the perspective of home sales. Now, where things kind of blipped up today was the S&P Standard & Poor's Services and Manufacturing Purchasing Managers Index. And this is for both services and manufacturing. They were forecast to be flat. Didn't turn out to be the case. The services number ended up being up 54.8 versus 51.6 the previous month. And with manufacturing, that was up 52.4 versus 50 on the previous month. So though they were forecast to be flat, didn't turn out that way. They were up. The markets did not react well to that, particularly the stock market, believe it or not. In fact, last I checked, we ended up about 600 points down today. And these PMI, the Purchasing Manager Index for both services and manufacturing, because these were hotter than expected, that's what caused our opening blip in the 10-year bond yield. Because we closed yesterday around 443. We opened early this morning about 450. But good news is it's settled down a little bit, again, to that 448 number that we showed you earlier. The other thing that kind of caused the markets to jump a little bit, the bond market, that is, initial claims for unemployment. That was considered strong, but it really wasn't that strong. The forecast was for the claims for unemployment to be 220,000 for the week, came in at 215,000. So that was, judged to be evidence of a strong labor market. Well, only a $5,000 variance from what was forecast to actual. I'm surprised that it caused that much of that much of a reaction in the bond market in terms of bumping that rate, that yield up. And then the last item for this week, which is forecast to be lower, it comes out tomorrow, is durable goods. So we'll see what happens. But keep in mind too, we're heading into a holiday weekend. And when that happens, usually these movements in the market, both stock and bonds, can tend to be a little bit more pronounced. And of course, the markets are going to close early tomorrow. So my guess is we're not going to see much change in bond yields as we go into the weekend because the market will close early tomorrow. If anything, it'll probably just sort of hold steady. I can't imagine it's going to get much worse. So there you have it. That's your current update on mortgage rates and the bond market. I think, again, relatively good news that we've had a relatively stable period of time here for over 3 weeks with that 10-year bond yield. It's nice to see that it's staying within that 435 to 450 range. So now I want to go ahead and go into actually the subject we talked about last week. I want to continue this. If you remember, if you saw the program last week, what I was talking about then was credit scores. And as I pointed out in my headline again there, if you're just a number, you need a good one. Because, in the mortgage business, I'm sorry to say, when it comes to credit scores, you are a number. That credit score number is vitally important in a variety of ways when you're getting a mortgage. And I, of course, last week went over how a lower credit score can affect your interest rate. And that discussion last week was primarily or focused on conforming conventional loans. And one of the things I pointed out, just as a reminder, agency and the PMI pricing, that's private mortgage insurance pricing for lower credit scores and higher LTVs, is at a cross purposes. And it can trap a borrower into the worst portion of the FICO LTV grid. Now, FICO, of course, we all know what that is. That's the credit score company that basically developed credit scores. And then LTV is loan to value grid. And of course, when I completed the comments about conforming conventional pricing and how credit scores affect the pricing that you can get on that mortgage, I pointed out that there is an alternative program that I think is a great alternative for those lower credit score borrowers who are looking to get a mortgage with a minimal or small down payment. And I pointed out that this alternative program is kinder and gentler for those borrowers with lower credit scores and high loan to values. And that program is FHA. And there's a couple of reasons for that. For one is FHA has a FICO LLPA grid. Now, if you remember from last week, LLPA, that's loan level price adjustment. So with an FHA loan, there is a grid that establishes how the pricing for that loan is affected by your FICO score. And there is different loan level price adjustments or price adds depending on your score. The lower your score, the higher the LLPA. Now, you can think of LLPA kind of basically the same as points. But again, the thing to note is FHA does not have a loan to value LLPA grid. In other words, FHA doesn't adjust your pricing or the rate you can get based on a minimum down payment or a higher down payment. There's no change to the pricing, whether you're putting 3.5% down the minimum or whether you're putting 20% down. That's not the way it works with a conventional conforming loan. In an agency, that's conventional conforming LLPA grid. The other thing you can see is the maximum spread from low to high for the LLPA price adjustment, it can be as high as 2.5 points, which that is substantial. Now, with an FHA LLPA grid, the maximum spread from low to high is only about 1.75 points for scores all the way down to 600 or higher. So let me show you this. On the next screen, and what I'm going to pull up here is the agency FICO and loan to value grid for purchase loans. Again, this is for conventional conforming Fannie Mae, Freddie Mac loans. And what you can see there is in the yellow portion between a 75.01 loan to value up to a 90% loan to value. So that's basically less than 20% down, up to 10% down. In that yellow portion, that's where you can see the highest LLPAs that can be charged. For example, if you look at the bottom for credit scores under 639, and let's say you're putting 15% down, that middle column of the three yellow columns. If you're under 639 and you're putting 15% down, there's going to be a 2.875%. That's 2 7/8 points hit to the pricing on that loan that you're trying to get on your rate because of that lower credit score and that down payment amount. Now, what happens in reality is borrowers don't pay those price adjustments as points. That's too much cash, and most borrowers are challenged with cash. So the way these pricing adjustments are handled in terms of the higher adjustments as you get into lower down payments and lower credit score, is that we adjust the rate to absorb this LLPA. So for example, again, 15% down if you're under a 639 score, where you're going to be hit with a 2 7/8 points essentially hit for your lower credit score and down payment amount. What we do is you absorb that through a higher rate so you don't have to pay it in cash. And one of the things I was pointing out last week is interesting to note on this grid, if you put less than 10% down, if you go up to 5% down, you actually see lower LLPA adjustment. For example, under 639, it drops from 2 7/8 down to 2 1/4. So Fannie and Freddie actually give you better pricing if you put less than 10% down when you have a lower credit score. But as I pointed out last week, that ends up getting offset by the PMI company charge, because the PMI companies aren't doing that. They're not giving a break to the PMI premium for a borrower with less than 10% down. They actually hit you harder, and that basically undermines the slight improvement in rate that Fannie and Freddie are giving you for a lower credit score and a less than 10% down payment. So as a consequence, you end up kind of getting stuck in that portion of the grid that's in the yellow. Now compare this to the FHA grid, which is what we're going to pull up next. With the FHA grid, it's much simpler. You can see this. There's a lot less LLPAs, again, loan level price adjustments. And in particular, you can see the spread there. Look at the 600 to 619 line item. You see minus 1.5 is what you will get charged, or what's going to be assessed on your loan, on your rate, 1.5 points essentially of your loan amount. Whereas if you're 740 or higher, you actually get a benefit, you get an enhancement to your pricing of 1/4 point. So what that really means is between a 740 score and a 600 score, the spread from low to high is about 1 3/4 points. That's, again, I call it kinder and gentler to the borrower than a conventional loan with similar type of scores. Again, those lower scores at 600, you're going to get hit 1.5 points for your loan level price adjustment due to FICO. Remember, on that other agency grid, you would get hit at 2 7/8 points, and that's at 620, where that is the minimum with conforming conventional, whereas FHA, of course, we can go down to 580 with a 3.5% down payment. So the point of this is FHA, when you're dealing with lower credit score and with lower down payments, and actually even not necessarily the lowest down payment, even if you go, 5, 10, 15, 20% down on an FHA loan, if you're in that lower credit score level, 600, 620, FHA is going to be a better deal for you in a lot of cases by far. So that's what I want to show you next, is I'm going to give you an example here of comparing an agency conventional conforming loan, compare it to an FHA on a particular price scenario. So that's what we're going to go to next on this next screen is I'm going to show you some numbers in terms of rate and monthly payment based on a particular price scenario. So in this case, what we're going to be doing is we're going to be assuming a purchase scenario where you have a purchase price of $750,000. Okay. And with that, we're going to assume that you're going to be putting 15% down. So your loan to value is 85%. And what we're going to do is we're going to compare conventional and FHA based on different credit scores. So you can see a direct impact on how your score affects both of these loan program types. Now, at a 780 score, the conventional rate, at least at the time I prepared this program, the conventional rate for a 780 score, you would be looking at an interest rate for a 30-year fixed conforming loan, 6.75%. Now that means the principal and interest payment is going to be $4,135. And then added to that, you're going to have a PMI premium. And for those parameters, 780 score, 15% down, your PMI premium is going to be $101 a month. Now, when you compare that to FHA, it's a little different story. Even with a 780 score, which is very good for FHA, and again, the same 15% down off of a $750,000 price, the interest rate for FHA, 5.99. So you're looking at basically 0.75% lower rate for the FHA program with the same score of 780 as compared to the conventional. Now, the FHA mortgage insurance, though, is higher. It's $264 a month. But still, when you add in the FHA rate, $599, the principal and interest for that rate, $38.85, add to that $264 for the mortgage insurance, well, the combination of your principal and interest and your mortgage insurance payment on the FHA loan is actually $87 a month lower than if you go conventional with that 780 score and the same down payment amount. Now, some folks would argue that, well, the FHA loan, though, the PMI is more expensive. Well, it's not actually PMI. It's called mortgage insurance. PMI remembers on conventional loans, not FHA loans. But some would argue, well, wait a minute. The FHA mortgage insurance overall is more expensive because you have both that annual premium of 0.55 and you have that upfront mortgage insurance premium of 1.75. Well, first thing to note is that principal and interest payment that I quoted you, $38.85, that includes the upfront mortgage insurance premium component because that's financed into your loan amount. So that $38.85 includes that. And then the $264 per month is actually the annual premium based on 0.55% of the loan amount. So as a consequence, even with that higher mortgage insurance for the FHA loan, it still comes out better with that top tier credit score, $87 a month. Now, the other argument would be, well, wait a minute, with a conventional PMI, a borrower does have the ability to cancel that PMI in the future based on certain conditions. That is true. But you have to wait a minimum of 2 years. And in most cases, it takes more than 2 years before you're going to be in a position to cancel that MI based on establishing you have an increase in your equity that no longer justifies the PMI coverage. So in the meantime, you're still saving $87 a month. And of course, also note in this first example, even if you are able to get rid of that PMI component for that conventional scenario in maybe 3 or 4 years, that removes $101. Well, the FHA was already ahead by $87. So you net that out, even after you cancel the PMI in year 3 or year 4, your benefit is actually only going to be net about a $14 a month better payment than the FHA. So in my mind, that doesn't make much sense to skip FHA and go conventional. I would go with FHA. Remember, you're dating the interest rate. So go FHA, save that $87 a month because for at least 2, 3, 4 years, it's still going to be a better deal than the conventional. And in that interim period, look for the opportunity to refi when general interest rates come down. So then, and there's the chart there. And again, I was just covering the top portion at 780 score. Now let's see what happens if your score is 680, not 780, 680 for that 750 price with 15% down. Well, first you can see that conventional rate jumps up quite a bit, 7 3/8. The principal and interest is now 44.03. The PMI goes up. It's now 149. Compare that to FHA, FHA rate goes up a little bit, not nearly as much, only 6.125. So again, there's a clue to you that FHA doesn't hit you as hard for a lower credit score on rate. 3941 is your principal and interest. Remember that principal and interest payment includes the upfront component, the upfront mortgage insurance component that FHA has, 1.75% of the loan amount. And then again, you see the annual PMI, which is actually paid monthly, $264. So the other thing to note is you're seeing there that at the lower credit score, 680 instead of 780, the FHA annual mortgage insurance of $264 a month doesn't change. It stays the same. So again, FHA doesn't punish you, if you will, for having a lower credit score as it relates to the mortgage insurance premium that they're going to charge. And in this example, at 680, the FHA alternative is $347 a month lower in housing expense. That's significant. And then it gets even better. At a 620 score, that conventional option, 15% down on a 750 purchase price, now your rate's really getting up there. It's 799. That tells you Fannie Mae, Freddie Mac, they're going to hit you really hard on that lower credit score of 620. Principal and interest is now 4673, and your PMI premium goes up again to 234 a month. Compare that to FHA at a 620 score. Your rate goes up slightly, another 8, 6.25. So basically from 780 score to a 620 score FHA, the difference in rate's only 0.25%. Again, much kinder and gentler in terms of your score. 39.94 is your principal and interest at that 6.25 rate. And look, FHA, even at 620, your mortgage insurance is still the same, 264. Again, it underscores the fact that you're not going to pay more MI on an FHA loan when you're at a 620 score instead of a 780 score. It stays the same. And so therefore, at the 620 score example here, the FHA option will save the borrower $649 a month in housing expense versus going with the conventional option. So the conclusion to these examples is, number one, I believe even at highest credit score possible for conventional loans, 780 or higher, FHA terms are going to prove to be slightly better in terms of monthly payment. Then at lower credit score, FHA terms get much, much better than conventional, particularly as you get closer and closer to that 620 or even down to 600. So the basic bottom line here is FHA is always going to be a better deal on rate and mortgage insurance when you're going with less than 20% down. Now, one caveat to that is be sure to consider county loan limits. For example, in our county here, we're in Coachella Valley and Palm Springs. The maximum FHA loan amount available in Riverside County is $644. Compare that to the conventional conforming limit of $766,550. So you do have that sort of $120,000 range between $644 to $766, where if you're looking at a home where your loan amount is going to be above that $644 FHA limit, conventional is basically your only way to go. So you don't have that ability to use FHA as an option. So again, you have to be careful of that depending on what county you're looking at. But that aside, if you're looking at a transaction where the county FHA loan limit is going to support the transaction you're trying to do, FHA, even if you're the top tier credit score borrower, FHA is probably going to be a better deal than the conventional conforming loan. The other thing I would argue, and a lot of folks don't think about this, if you're at a 620 or 610 or 600 credit score, and even if you're putting 20% down, 25% down, of course, the initial knee-jerk reaction is, I'm not going to go FHA because there's mortgage insurance. I'm putting 20% down where there's not supposed to be mortgage insurance, which is true on conventional loans, but not on FHA. Regardless of how big your down payment is, FHA is going to charge mortgage insurance. However, let's say you're putting 20% down, you're putting 25% down, and your credit score is 6.25, 625. Well, with a 625 credit score, I've shown borrowers countless times they would still be better off going FHA with the mortgage insurance compared to the conventional loan that wouldn't have mortgage insurance, simply because the rate is so much better. And then when you layer in the FHA mortgage insurance, your effective rate is still better than the conventional loan that doesn't have mortgage insurance. So the bottom line here is FHA is a better way to go with minimal down payments for sure, from highest credit score even down to the lowest. And if you're looking at a transaction where you're not a minimum down payment, but you're looking at 20 or 25% down, and you've got a low credit score, FHA is going to be a better option, even though it's got mortgage insurance and the conventional loan does not. So as you can probably tell, I'm a big fan of FHA. I think it gets underutilized quite often, doesn't get thought about. Whenever I have an opportunity, when I'm pre-qualifying buyers, I always bring up this aspect so that they're fully informed of what their options are. And what I find is once I show them how FHA can be better on terms in almost all scenarios of down payment and credit score levels, then usually I can convince the borrower that it's a better way to go. So hopefully that helps. Keep this in mind when you're looking to buy a home. Again, particularly if you're a little bit more credit score challenged, FHA can certainly be your friend. We'd be happy to give you some numbers to help show that to you. So with that, I want to go ahead and go into a subject that we've covered a lot last several months. I've got a new one for you. I'm kind of excited about this one. This next subject is, as you may recall, a few weeks ago, I came up with this concept of buy downs are the bomb. I've been talking a lot about temporary interest rate buy downs. And I have another really good real life example that I'm actually working on right now. This is a situation. I got a call from a past customer literally 2 days ago. Their existing home, which I put the loan on that about 4 years ago, they've got it in escrow. It's going to be closing soon. So they're looking to buy another home near this market area. In fact, what they're looking at is a single family residence. It's featuring 4 bedrooms, 3 baths, 2,602 square feet. It's listed in Beaumont, city of Beaumont, which is just west of here in Palm Springs. It's listed for $575. It was built in 2007. The days on market is 16 with no offers and no adjustment to the list price. Listing indicates the property's got new AC, water heater, and it's got a 3-car garage. My borrower's looking at this because they have a family, a couple of young kids, and they're looking to basically move up to a bigger home, a home that's more situated for a growing family. So when this borrower contacted me to alert me that he was going to need my help to get pre-qualified so they can make an offer, he told me about the property. And one of the first things he told me was that they were contemplating offering $550. And of course, as I am prone to do now on every occasion when I'm presented with these kind of scenarios, I suggested to my client they should consider an alternative. But in any event, let me first show you what my borrower's suggestion in terms of offering $550, what that would mean in terms of financing. So at a $575 price, they were contemplating a $550 offer. That's a $25,000 price reduction. Also, they're going to be putting 25% down because, again, they've got their current home in escrow and they're going to have a good amount of proceeds to use for a larger down payment. So at a $550 purchase price that they're contemplating offering, loan amount's going to be $412. The principal and interest at 6 5/8, which I prepared this earlier this week. The rate was that good a couple of days ago. At 6 5/8, the principal and interest is $26.96. Now, of course, what I said was, as you probably know now, I said, well, wait a minute. Try offering the full list price. Don't offer $550 with no seller concession beyond the price reduction. Offer $575, but get that same $25,000 concession from the seller. Get it as a credit that you can then use to pay for a 3-2-1 buy down, as well as your closing costs. Well, in that scenario, at a full list price offer $575, your loan amount's going to be higher. It's $431 versus $412. But look at this. At a 6 5/8 note rate, the principal and interest for that $431 loan amount is going to be $27.60. Again, that's a little bit higher than if they just went with that lower price offer of $550, where it was $26.96. So yeah, it's a little bit higher on the note rate payment. But look what happens with that 3-2-1 buy down. First year, interest rate of 3 5/8. Principal and interest is only $1965. That's $795 a month lower than the note rate P&I, principal and interest. The second year in 4 5/8, $22.16 per month for principal and interest. $544 a month lower than that principal and interest at the note rate. Third year, 5 5/8, principal and interest $24.81, $279 lower than the principal and interest at the note rate. Over that three-year period, the borrower is going to save $19,000 in monthly payments over that 3-year period versus the market rate payment. Plus the fact, with that $25,000 credit, there's going to be money left over because a 3-2-1 buy down is only costing about a little over $19,000. So there's over $5,000 left over from that seller credit that the buyer can use to apply toward their other closing costs. So again, this is another perfect example of, I have a borrower call me, somebody I've arranged loans for before, wants me to pre-qualify them on a home purchase, tells me they're contemplating submitting an offer below list price. I instead suggested, don't do that, offer full, get that same concession amount, that same $25,000 that they would have gotten just a lower price, get that in dollars, apply that toward your financing. Your outcome is going to be a substantially better financial scenario, payment schedule over that first 3 years. And again, as we keep talking about, that way you can get the house, marry the house, but you're dating the rate, you're dating the interest rate over that 3-year period with the benefit of that buy down. That gives you that 3-year window to look for overall market rates to fall. You can then refinance your note rate into a lower rate long term. And if you do that during that buy down period, where not all the buy down money is used, the leftover buy down money, you don't lose it. It gets applied to the payoff of your existing loan when you do refinance that note rate during that 3-year window. So again, sorry to keep harping on this, but I'm talking about it all the time. It's an effective way to get homes sold. Temporary buy down at full or near full list price features superior payment terms over a lower price offer. So if you're looking to buy a home, you're contemplating a lower price offer, call me. Let me at least give you some numbers on the alternative like this so you can do a good apples to apples comparison and convince yourself that a temporary buy down in the right purchase scenario is a much better option for you financially. And I think you're going to find that that's going to be very helpful for you in order to gain home ownership and take advantage of what I think is going to be a continuation of appreciation in property values going forward, even after rates fall. So again, a very good example, a live one right now. We're working through this, hoping we can get the buyer, get their offer approved based on these kind of terms. So with that, I want to go ahead and move on to our closing question from last week. And this is actually a pretty good question. And let me go ahead and show it to you. The question was, why are some mortgage programs offered with only a 3% down payment, but then you find out you need more than 3% of the price to complete the purchase? That's a good question, but actually it applies even when you're not talking about 3% down. I run into this frequently, pretty much, frankly, all the time. I'll get a customer saying, I'm going to put 5% down, pre-qualify me. I'm going to put 10% down, pre-qualify me. I'm going to put 20% down, pre-qualify me. What happens is borrowers, when they think in terms of their down payment amount, that's all they're thinking about. They don't realize that the actual amount of money that you need to close a purchase transaction in most cases is not just your down payment alone. There's other dollars involved. So let me explain what that means. At any loan to value, down payment does not reflect the total funds you need. What is down payment? Well, let's define it. Down payment defined is purchase price minus loan amount, nothing more, right? So if you're putting 3% down on a $600,000 purchase price, yeah, your down payment's $18,000, but that's not the full story. Why? Well, there's another concept. It's called cash to close. What is cash to close? Defined. Well, cash to close is your down payment, as defined above, purchase price minus loan amount, your down payment, plus your recurring and non-recurring closing costs. Now, I've seen articles, I've seen some news stories about trying to guesstimate what the average closing costs are based on a percentage of your purchase price. I read an article the other day that suggested that your average closing costs on a purchase transaction is going to be 3 to 4% of your purchase price. No, that's definitely on the high side. In fact, that's too high. In fact, I would argue it's not easy to define your closing cost amount based on a percentage of purchase price or loan amount. You can't easily define the amount of the closing cost based on a percentage of your price. The amount of your closing costs are going to depend on various factors: what your loan amount is, whether or not you want an impound account, whether or not you want to look at possibly taking a higher interest rate so you can finance those closing costs into the rate rather than paying them into cash, as well as other factors. So again, the bottom line is here, whether you're looking at buying a home as 3% down or 10% down or 30% down or 50% down, your cash needed to close is going to be that down payment, price minus loan amount, plus your non-recurring and recurring costs. I would say on average, non-recurring and recurring costs, 3 to 4% of your purchase price. No, that's too high. Maybe 1%. Yeah, maybe a little bit more than that in some cases. Again, it's going to vary. We show you that in detail when we're pre-qualifying somebody. One of the things we do is we give you a worksheet right up front so you have a better idea of what's really needed to close your transaction. So if you need any help with that, give me a call. We always believe in getting you some detailed worksheets with all the numbers up front, even before you've made an offer, even before you've formally applied for the loan. That way you're better informed on all the numbers, and you're not fooled or you're not surprised later that 5 or 10% down payment amount that you were thinking about is all you need, because in most cases you're going to need more, at least until you start negotiating to maybe get a credit from the seller to pay those for you. So I hope that clarifies a little bit in more detail how it is that when you're thinking about your down payment, that's not the whole story as to what you're going to need to close your escrow. And with that, I'm going to go ahead and go into the last question, which is our closing question for next week. And here it is. In fact, this is a good follow-up to what I just covered. In fact, what I'll do is maybe next week I'll go into this in a lot of detail, this closing question, because I think there's a lot to it and a lot of misinformation and misunderstanding about the subject. So the question is, what exactly goes into mortgage closing costs? Well, stay tuned until next week, and I'll give you the answer, and it'll be on the house. So with that, that concludes our program today. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. If you need any information about anything we've discussed, you're curious about what your credit score means in terms of rate, you're curious about getting some numbers on a temporary buy-down scenario. And of course, don't forget, we have all kinds of solutions for equity lending, both HELOCs, HE-loans, fixed rate seconds, as well as reverse mortgages, both for purchase and refinance. And again, don't forget that Home Safe Second reverse mortgage, second mortgage, it can be very helpful for those homeowners who are over 55, need to tap into their equity, but they're having trouble doing that because of various reasons like lower income and so forth. They've got a low first rate mortgage they want to protect, but they need to get into that equity. We can help with that too. So keep us in mind. Feel free to call me, email me, send me a text, and we'll get you some numbers. So that concludes our program for this week. Thank you for watching and listening. Again, my name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. So long. Take care. See you next week.